You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Happy Thursday. Kind of like a good news, bad news today. Bank of Canada cut their rate again yesterday. So it went from 3.25 to 3%, so a 25 basis point drop. Not too much, but I mean, when you think that last summer we were at 5, it's pretty significant. So it's like a 2% drop in like 6-7 months time frame. So it's definitely good news if you have a variable debt. So if you have a variable mortgage or a HELOC like I do. I mean, of course, I've smiled yesterday thinking that my interest rate has been going lower a little bit more. So that was good. And just want to say that if you are thinking for a long term, so like the term of like your HELOC, your mortgage, that will likely be 20, 25, maybe 30 years, depending on how long you want to push the envelope. Going for variable rate usually is the best choice. Of course, you must have flexibility in your budget and the ability to pay higher mortgage payment when the interest rate goes up, which just happened between 21 and 24. But now, I mean, it was like 2 bad years. Like when I look at my experience, I've been a homeowner since 2006, so almost 20 years now, 19 to be precise. And out of like 19 years, I got like 2 bad years of interest rates. The rest of it was like pretty low. So overall, it was a pretty good decision. But of course, it requires you to not mind rapid interest rate increases. So it's also eventually good news for people that have mortgage that needs to be renewed in a few years or even this year. But it usually takes a little bit more time. So keep in mind always, and I think we don't repeat that enough, but short-term rate, overnight rate will not have a direct impact on long-term mortgages or bonds because those are, yes, of course, following a similar trend, but the 4 or 5 years mortgage rate will be tied to how bonds react over time and not the short-term rates. So there is, of course, like I said, kind of a link. So it's really rare that you're going to see overnight rates dropping like this and long-term rate going up. But the drop might not be as generous. Just keep that in mind. All that to say that, yes, it's good if you're about to renew debts and so on. It's like kind of like a good news, if we could say that, for consumers. But it's not really in good news in general. So what's happening here is the economy is not doing that well, and the Bank of Canada is doing its best to support it. So what the BOC does, well, it manages the economy and the inflation, and the most important thing for the Bank of Canada is to get an inflation around 2% and to make sure that it stimulates the economy. Of course, they have a few tools that they can use, but the most important one is how they manage the interest rate. They could buy back bonds, which we would call QE, so quantitative easing, but usually they prefer to just play around with the interest rate, which has the most impact. So now the inflation, the last time it was reported was at 1.8, so big drop from the past 2 years. Definitely under control. The target, as I said, is 2% to have like a healthy and growing economy. So at 1.8, it's almost like too slow, which, I mean, it's, again, good news for consumers. But overall, when you think about the economy of the country, not exactly the best thing. And here's another sign that it's not doing that well. Well, the unemployment rate has been stable as of late, but we're still high, sitting at 6.7%. It was 6.8 the last time they reported data before that. But being close to 7% unemployment rate, It's pretty high, and the clouds are not getting away here. I mean, the clouds are actually getting darker if you look at what's coming up for the rest of 2025. And we're just finishing the first month, so it's not necessarily good news either. Of course, the elephant in the room, tariff wars, right? It's going to be fun to follow this drama series on HBO this year. A lot of trade tension to be expected between the US and Canada. We're gonna like they have like the US government reinstated that they're really targeting February 1st, which is in a few days now, so to start imposing tariffs. So it's going to be a bit scary and of course really interesting to follow the story. Don't put too much time doing that and energy trying to figure out scenarios, because between you and me, you're gonna lay out 100 scenarios and none of them will happen the way you thought they would, and it's going to be another scenario that's going to happen. So thinking too much about the future, it's not really useful, and then you're going to make a bunch of assumptions. Most of them will be wrong anyway, and I'm telling you this, but I mean, I would be wrong too. I'm just not going to do those assumptions because I know that I cannot predict the future. So I rather stay with my portfolio right now as is, and then I'll see how it goes. So even the Bank of Canada admitted that it is limited right now in what it can do. So if we have tariffs as it's highly expected, well, it means less productions of goods, right? And less production of goods, of course, means like a weaker economy, definitely is still down, and likely a higher unemployment rate. So all of those economic metrics that we're tracking, so that's like consumer confidence, the housing starts, the unemployment rate, the GDP, all those numbers are not going to look good going forward, at least short term for sure. So Bank of Canada is thinking, well, we're going to continue to drop the overnight rate to try to give a little bit more breathing room for the consumers, but that's pretty much what it can do at this point. I mean, it's not like it can create jobs. So what are the solutions that are going to come up in the coming days, in the coming months? Well, a thing that I keep hearing about these days is the fact that a lot of people are saying, well, why don't we just double down on our own economy, invest more in Canada, buy more in Canada, which is kind of interesting. And one thing that the government will likely do, because it's part of their classic playbook to stimulate the economy, and it works. So, I mean, nothing wrong with that, is to invest in infrastructure. They already know that it is required anyway, but now they kind of have like the perfect excuse to say, yeah, we're just going to invest a little bit more in infrastructure, and that could be a good way to boost construction industry and create more job in those fields, trying to compensate the job that we're going to likely lose in other industries. Of course, it's not like perfect, and it's not because you work in a manufacturer, for example, that you'll be able to move and become a plumber tomorrow morning. It's not exactly how it works, but by creating more jobs, you at least support the economy and you maintain an unemployment rate that is closer to a healthy and growing economy, which could be nice. All of this to say that at this point, and I've been bullish on like the infrastructure industry and a lot of like those companies for a while now. I've placed my portfolio already to benefit from this long-term trend. I'm not in a hurry to reap the rewards of those trades, but I'm good. Like I bought like Toromont Industries, I bought Stantec, I got rid of like Magna International last year. So, small changes. Overall, it's not like my portfolio has been completely transformed into a heavy part into the industrial sector. Far from it. In fact, about 10% of my portfolio is invested in industrial stocks. So it's not that much. But I will certainly, if I have to buy another company and add more to my portfolio, I will certainly look into this sector because they have like many industries that are quite interesting. To help me do that, I will actually use the Rockstar list. So the Rockstar list is a list of stocks that we produce at Dividend Stocks Rock from our stock screener, and I focus my research on only companies showing revenue growth, earnings per share growth, and dividend growth over the past 5 years. The key here is we're investing at an all-time high. I want to make sure that I buy quality companies. I don't want to take bets on business that show shaky financials, because if we get into a recession, it's going to look very bad. So I've cleaned up my portfolio a long time ago. Now I just focus on those high quality companies, and the Rockstar list helps me to do that a lot. So you can actually download the Rockstar list for free if you're not a member at Dividend Stocks Rocks. You can go to moosemarkets.com/rockstars to download it. And as soon as you subscribe to the free newsletter, you're going to receive an updated list of the Rockstar list every single month, which is kind of cool. Of course, if you're a member, you can add more filters, you can add more metrics, you can tailor it to your tastes, which is exactly what I do on my side because I have full access to my own membership, right? But I mean, if you want a free version of it, it's a pretty good start to find interesting companies. So moosemarkets.com/rockstars. All right, Moose, that's enough for today. Tomorrow, we are talking about retirement and what makes a successful retirement. Not that easy, actually, when you're about to retire. It needs a lot of preparation. So we're going to talk about this tomorrow. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.